For those who don't know us, we are the Serene team, and we are here with our amazing lender partners, the Schultz team over at New American Funding. We have Ryan and Bryce with us today. And just a little quick note about them. These guys are just amazing lenders. And ever since we've linked up with them, our roles as the realtor has become infinitely easier because it's just really competitive out there right now for first-time home buyers. So what that means is odds are on the properties that we're going to be writing offers on, we're probably going to have competition on it. And so the terms of the offer start to become very, very important. And because the Schultz team, they're like number 3 nationwide in the whole company, their processing times, they're at the very top of the priority list. And so we can close deals in only 17 days. And our competition is looking more like 30 days. And so when we just submit our offers, we go to the listing agent, we explain these terms, and then the listing agent is motivated to kind of help us win. Maybe like steer us a little bit with like what the other offers look like price-wise so we can edge in just a little bit higher because they want to work with us because our terms are better. So really can't say enough about these guys. It's just been a real pleasure ever since we started linking up, and it's been a really nice partnership. We know that it certainly has helped our business grow. So yeah, I will let them talk about loans in 1 second, but first let me introduce you to the Serene team. We've got Howard Chang.
What's up, everyone?
Extraordinary realtor. Howard is just killing it. He's having his best year yet. The same goes for Vanessa McCaffrey.
Oh, thank you.
Another amazing agent on the team. Everyone's kind of having breakout years right now, and it's just been a real pleasure, forming the team at the top of the year. And, we haven't really looked back. So it's been super fun. And then the yin to my yang, Pilar Oliva, she is the director of operations, also a realtor on Serene team. And she counters me so well. I can be all over the place and scattered. And she's like, Kyle, this is what you have to do. And so
Yeah.
much love to Pilar. And so throughout this little webinar here, if you guys have any questions, just type them in the chat box, and Pilar will kind of be moderating them, maybe responding to some just in the chat. But we're gonna have a few different breaks, and during these breaks, it's the Q&A, so she'll just kind of like handpick some questions, and we shouldn't have a hard time getting all questions answered. So yeah, we're looking forward to it. And to kick it off, I just want to give you guys a little story here. I'm going to do a little screen share that just kind of explains why we're even all here talking about home ownership. So these are some buddies of mine, and they are complete hooligans. And they just leveraged real estate so well. And it really is just the whole kind of point here. And that's really just like, once you can afford it, you need to just get in the game. Some people, they kind of get it wrong, and they say, oh, I just need to save, because when I buy a home, it needs to be perfect. It needs to be my forever home. And that's just dumb, because you're missing out on, the principle of stop paying your landlord's rent. And then over time, you're going to live in this place, and then you're going to have equity built up in it, so that then when you sell it, you're in a much better place. You can afford a much nicer home. So oftentimes the first home that you land, it's not your forever home. And it certainly wasn't the case for these guys. So let me show you their first home. This is when I sold it for them after they bought it, but it's in Northwest Pasadena. They bought it for $515,000, and they sold it in just about 2 years after they bought it. And, it was cute. They bought it updated. It had been remodeled already, so they really didn't put a whole lot of work into the place. But just a really cute, tiny 780 square foot, 2-bed, 1-bath home in the emerging part of Pasadena Northwest. You can see here, it's like kind of right on top of the freeway. So it's about as like entry level as it gets. And these two, they put 3.5% down. They used an FHA loan. I'm sure Ryan and Bryce will talk about, down payment options and all that. But You know, at 515,000, let's just do a little basic math here. 3.5% of that is 18 grand. So we're really not talking about a whole lot of money here. And they just have very normal jobs. I don't think either of them makes over 6 figures. And then they got in this home and they just let the property appreciate. And 2 years later, they called me and they're like, hey, we kind of found our dream home. Is this even like a possibility? And I was like, I have no clue, man, but let's just kind of go through the motions. And so we figured out that they could just barely get in if we sold their home in Pasadena. And this is in Altadena. It's a much bigger home, 3-bed, 2-bath. There's a pool in the front, a big backyard in the back. That's redundant. And it was just like their dream home, basically. And their vocational income didn't increase really over the course of that time, but they were able to sell the property in Pasadena and make a pretty penny on it. We sold it for 600. They bought it at 515. So that money was a huge factor in them being able to pull off this move here. So I just really think they nailed it so well. And it's again, just the perfect example of get in the market however you can. And you're just going to have so many more options once you do that, rather than just renting for years and years and years and you know, quote unquote, saving for years and years and years. That's just not the approach. And just from a general like investment standpoint, it's absolutely crazy real estate, because like, let's think about what they did. They bought a home where the bank was their partner and the bank paid 96.5% because they were at 3.5% down. Yet the bank didn't share any of the profits on the appreciation. They only put 3.5% down, like 18 grand. There were some closing costs, sure, but like, let's call it like 25 grand. They were probably all in on the property. You know, and then they were able to realize just big profits. The bank didn't take any because the bank they make their money on the interest rate, which by the way, right now we've never seen lower interest rates. So you guys are definitely in the right place here to be learning about real estate, learning about how to use that as a wealth building platform. So hopefully that gets you guys a little bit excited. And now I want to pass the torch off to Ryan and Bryce to talk about how the heck you get financing for these deals.
All right, how's it going, guys?
Good.
So, all right, cool. So yeah, what Kyle showed there was awesome, right? I mean, that's just one of many success stories. So we've been doing this a long time. I've been doing this actually about 25 years, and same thing Kyle said. When I first started getting into this, like everybody's kind of scared to take that first step. I got tons of friends that didn't want to purchase, and they waited and waited, and then they finally got in. Like I got a good buddy that I think of when I think of his story right there. And he waited forever, finally had to fix his credit. We looked at it, finally told him, hey, you could buy this house with FHA financing. And I think the home was like 330 at the time. And he needed like credit repair that we had to work on. And then he actually bought the house with a down payment assistance program. So he didn't even put the 3.5% down, right? He was able to get a down payment assistance from the state. So he basically got into this house with almost zero, right? So there's programs like that. He bought the house. At the time, he had an FHA loan with mortgage insurance. His payment was probably a little higher than he felt comfortable with, but same thing, young family, got into the property. Literally a year later, we refinanced his property because it went up about $100,000 in value. He was able to refinance. He paid off the FHA loan with a conventional loan. He removed the mortgage insurance from his payment, which was about $300, and he paid off the down payment assistance. So he was able to drop his payment, pay back the loan he got from the state, and he was super happy. He was, very happy, loving life, all excited about it. About a year later, his home went up in value again. We refinanced him again, pulled out money this time, redid his whole house, remodeled the whole thing, put a pool in the backyard, put a, little barbecue area, a fire pit, like just completely customed out the house the way that he wanted. And literally his house is probably worth like $700 now, and he owes $350, and he has like a great house. So it's just it's something we see all the time. You know, it's like he got in, bought that house. Again, at the same time, a bunch of friends didn't. They were scared. Hey, we're going to wait. Things might get better. And so he's got buddies that are still sleeping on the bunk bed at their mom's house. Bryce, kidding. No, they got a bunch of people that did not get in, and now it definitely is much harder, right? The prices are higher. So as you wait, everything continues to go up. And like Kyle said, like once you make that leap, you get in, and you know you're making the payment. It's your house. You're going to be able to write off that interest. The home is going to appreciate. In California, there rarely does it decrease, right? If you keep it a little bit of time, there's always some appreciation here, and so it's a great way to go. So just a little story, but yeah, just to explain what you need to do when you're a first-time buyer and you're looking to buy a property, you want to make sure that you can get the loan first. So that's always the first step in the process. So before you start looking at homes, you have to talk to one of us or any mortgage company, and we're going to be looking at a couple things. We're going to be looking at your credit. We're going to be looking at your employment history. We're going to look at your income and your assets. Those are the four main things that we need to look at to make sure that you are eligible now. Okay? It doesn't cost any money. So this whole pre-approval thing is like a consultation. It doesn't cost you anything, right? So we're going to look at that stuff and just to kind of go through those pieces with you real quick. So like the credit piece, right? We're looking for basically a credit score of 580 or higher. So 580 would be the bare minimum kind of. So if you're below 580 at that point, again, we can look at your credit report and we can say, hey, based off what I see here, if you pay down this credit card by X amount, if you close this account, we're going to be able to, you'll get 20 points. So we can kind of give you like a mini credit consultation. A lot of times there's stuff we can run and look at and we can tell you, hey, based off this, we can get you, or you can get 40 points. And so we can kind of guide you in the right direction. If it's really got a lot more to it, then we can refer you to like some credit specialists. But the main thing is you want a 580 or higher credit score. The higher you are, kind of the better, right? They're always kind of looking for higher credit scores, which makes it easy to approve you. But the 580 is the number there, okay? On your credit, the certain things that we look at again are collections, bankruptcies, charge-offs, things like that. So there's certain things that have a bigger impact than others. So if you've had a bankruptcy, the minimum waiting period to get a loan after the bankruptcy is 2 years. So if you've had a bankruptcy, we basically need you to wait to that period before we're going to be able to qualify you. If you have some collections, it may not be a factor at all, right? If you have a lot of medical collections, people get worried, I got a bunch of medical bills and collections I didn't pay. The medical collections, we do not even count against you at all. So a medical collection does not need to be paid off. We actually kind of ignore it, okay? So you're fine with that. You think what else you might have on your credit? Anybody got anything that they think about with credit that they're going to have a question on?
Loans.
Yeah.
School
What about
loans.
like student loans?
School loans. Okay, yeah, this is actually kind of a biggie right now. So school loans are usually deferred, right? And it used to be great about 2 years ago. If your student loan was deferred for 12 months or longer and there was no payment, we counted no payment against you, which was great. They changed that about 2 years ago to where we physically have to put in a payment whether you're making a payment or not. So usually the kind of the rule of thumb is 1% of the balance. So if you have 100,000 in student loans, we are going to artificially put in a payment of $1,000 a month right there. Okay? And this kind of with the COVID stuff too, with the forbearance, like if your loan's in forbearance due to COVID, they don't allow that, right? They're going to make sure that you're out of the forbearance and that you either are making a payment or we put in this kind of artificial payment. But where the payments come into play on getting pre-approved for a house is that's part of your monthly debt. So when we run the credit, we're looking for the score. We're looking for any derogatory stuff that I just talked about to see if there's something that's going to hold you back now or if we can fix it or if you're fine. And then we look at the monthly payments. So the monthly payments, we will take all the minimum required payments on your credit report. So car loan, Nordstrom's, all your normal stuff. We're going to add it all up, and that is considered your monthly debt, all right? So let's just make it easy here. Let's just say you have $1,000 a month in minimum payments. So if your credit report, if you're paying on a credit card, let's say you're paying $200 a month, but the minimum on the credit report says 25, that's all we use. Okay? So if you have $1,000 a month in minimum payments, that's going to come into play when we figure out how much loan we can give you. Okay? So the first part is the credit that we're looking at. The second part is the employment history. So we need to make sure that you've been on your job or in the same field of work for 2 years or longer. Okay? So they're going to say, they're looking for stability, right? Kind of like, is it a brand new job? If so, how long have they been on the job? If it's a brand new job, but they had that same kind of work and they just transferred to a new company, and we can like source or trace back your job for 2 years, that's fine, right? What they kind of don't want to see is like, you got a big gap between two jobs, right? You didn't have work for a year, right? Or you're brand new at a job that pays you a commission or something like that they can't show proof of for 2 years or longer. So they're always looking for like a 2-year work history. If it's a salaried position, like let's say you went to school and you're coming out of school and you got a degree in marketing or something and you get hired with your first company and you get a salaried position at $80,000 a year, you do not need 2 years, right? We will use the school history as the 2 years. So we get proof of your diploma or your transcripts, and we say, hey, they went to school for this. Here's the job offer from the employer. It states they're going to start on this date with this amount of money. Then that's a lock. We can use that right there. So we would use the $80,000 a year for your income. If you're going to a job that's hourly pay, now again, it could fluctuate. So they're going to want to see, are they working 40 hours? Are they working 20 hours? Like what's the average income or average hours that they're working? So usually you got to be on the job 6 months or longer if it's going to be hourly, and we're using that income. Okay.
And do you use the minimum amount of hours, or do you use like the most consistent amount of hours?
Good question, right? So if they are paid hourly, we're always going to look right off the bat at their pay stub and see if they're 40 hours. So they're kind of looking for 40 hours plus. If they're making $20 an hour and they're working 40 hours, and we can see that consistently on the pay stubs, and we're going to ask for 1 month of pay stubs usually, right? So if you get paid weekly, we're looking at 4 pay stubs. Hey, are all of them showing 40 hours? These two show 40, but this one shows 32. As soon as there's like a variance in there, then usually they're going to average your income out. They're going to say, hey, they don't always work 40 hours, right? Sometimes they work less, sometimes they do whatever. So they're going to do an average of the last usually 2 years of your pay.
Okay.
So it gets a little bit different where they're looking at the hourly pay, and if they can confirm it's 40 hours and now you have some overtime as well, we can use the overtime to add to your qualifying if you've had it for 2 years or longer. So this is where we got to make sure you've been at the job or same field of work, and we need to get a printout from the employer stating, they made X amount per year. Part of it was this much was the base income and this much was the overtime. Okay. And then we can use that. If it's been less than 2 years, we can't use the overtime income to help qualify. And that goes for bonus and that goes for commissions as well. So all of those need 2 years or longer.
Okay.
Okay.
We got a question on what about self-employed people?
Okay. So self-employed works kind of like commission and bonus and stuff. You need a minimum of 2 years. So if you're self-employed, you just started your business, you're not going to qualify at this point. They're going to want to see that you filed your taxes for at least 2 years. And then we have to use the income that is the adjusted gross income. So if you filed your taxes and let's say you had gross sales of $100,000, that's going to show up on your Schedule C on your tax return. And you're going to see it on your top line. How much did I gross? I made X amount. And then you're going to have expenses that go down. And this is where the accountants usually try to make the person not hardly pay anything on their income tax. So they'll write off all kinds of stuff. The problem is we have to go off the net adjusted gross. So we go off the bottom line number. So whatever you paid your income tax on is the number we can use for qualifying. So we will do a 2-year average. So we're going to take whatever the adjusted gross was in 19 and the adjusted gross in 18 and divide that by 24 pretty much.
And this is a big point, you guys, because we have, it comes up a lot with self-employed people where they're like, I make so much money, like I'm going to be able to get such a cool house. And then exactly what Ryan was saying, it's what you claim, it's your net. And so oftentimes self-employed people can be disappointed that they're not being pre-approved for a higher amount. So it certainly is worth having like strategy conversations with people like Ryan and Bryce, and then involving your CPA in as well, because it might be the case where you have to pay Uncle Sam a little bit more money while you're in this preparation stage to purchase your house. Then once you purchase the house, then, you know, claim as little money as you can possibly get away with, of course. But it's a little bit, you have to strategize it if you're self-employed, if you're going for a home loan.
Right, and there's a couple little things to that. So it's usually a 2-year average, but if you've been self-employed for 5 years or longer, they will use the most recent tax return. So like if we were looking at your tax returns now and we say, hey, based off what you claimed the last 2 years, you qualify for X amount, 300,000. Now that it's kind of getting close to the, you know, the end of the year, let's say we tell you how much you kind of need to show next year, or you go and you get your tax return, your taxes prepared from your CPA, and tell them not to file it yet, do a draft copy, right? So they'll put your tax return together, you get your draft copy, you send it to us, and then we say, okay, based off what you showed in 20, you're now qualified for this, but you're qualified for 500, but you're looking to qualify for a $600,000 house. Then we would say, okay, what you need to do is show this amount at the bottom, right? And then you could take it back to your accountant and your CPA and go, hey, I need to show 112,000 this year. If I do that, how much am I paying in taxes? And then you can decide if that works. If it does, perfect timing to catch it before you file, right? So you know how much to show. And like Kyle said, you may only have to show it for the 1 year, right? So you show extra money the year that you're going to buy. And then after that, you can go back to, you know, having losses and pay a lot less. So, okay, so that's the self-employed. Any other questions there? Okay. All right, so the income piece determines how much house we can get you approved for, right? So let's go back to saying that person that you know makes 80,000 a year. So 80,000 divided by 12 and 6,666 a month in gross income. So we are looking at the gross before taxes. And then there's a thing called a debt ratio, which determines how much loan we can give you. So the basic debt ratio is like 50% of your gross income. So 50% of that $6,600 number is $3,300, right? So we'll take that and say, okay, that's your total allowed debt. So from that, now we have to subtract out whatever was on that credit report. So let's say you had, like I said, minimum payments of $1,000. So we would subtract it from the $3,300, the $1,000, your other debt, and what's left over is your house payment. At that point, we'd say, okay, you're eligible for a house payment of $2,300. And then that's how we can kind of figure out what the price of the home will be, right? So the debt ratio is the factor. That's where the student loans come into play. That's where like the car payment comes into play, right? If you're thinking about buying and you didn't get pre-approved yet, and then all of a sudden you went out and bought a car, and now you're ready to go buy, and we look at it and go, hey, the $600 car payment obviously takes away from the house, right? That's $600 that could have been part of your house payment. So it can make a huge difference in how much you qualify for. So the debt ratio is a big factor. So 50% is your kind of your rule of thumb. FHA, we can actually go higher. We can go to 56% of your income. So that's why sometimes people go with an FHA over a conventional loan, because you can sometimes buy more home. You can get approved for a higher amount. Yeah, so that's the income piece. The last piece of the puzzle would be the assets. So they are underwriting. What we look for is enough money in the bank to cover the down payment, the closing costs, and the prepaid items normally. Okay, so the money needed from the buyer is usually the down payment, which will be 3.5% of the sales price. And then you have closing costs, which are third-party fees. There's things like an escrow fee, title fee, an appraisal on the house. Usually it all runs somewhere around $5,000, I would say, for the most part. Then there's a thing called prepaid items. These are not closing costs, but it's kind of like a savings account really for the buyer. Like we are going to require that we collect certain things from you up front. We're going to make sure we collect the first year of insurance to pay your fire insurance on your house for the first year. And then we have to collect enough property taxes to make sure that we have money in the bank, basically in your account, to pay your taxes when they come due. But when you're like a first-time buyer and you're buying a property, if you're putting down less than 10% on the house, then we have to collect the taxes and the insurance as part of your monthly payment. Okay, so we are going to not only collect your mortgage payment, but we're going to collect the property taxes, the insurance, and that's your total payment. When you make that payment to the mortgage company each month, we are putting aside the property taxes and the insurance amount into a thing called an escrow account. You get your monthly statement, you see it on there, it grows every month, and then when the tax bill comes, we pay it for you. And when the insurance bill comes, we pay it for you. So it's your money, but we got to make sure there's enough money there to pay it for you. So when you buy the house, depending on the time of year and depending on when the taxes are coming due, we may have to collect 2 months of taxes, we may have to collect 6. Right now, if you're closing, we're collecting about 9. So sometimes it can be a higher amount of money. But again, it's your money, it's just being held, and then we use it to make sure that there's enough going forward. So normally the buyer is responsible for all those 3 things, right? The down payment, the closing costs, the prepaid items. But the closing costs and the prepaid items can be paid for 2 other ways. So they can be paid for as a seller credit. So I know this obviously gets hard too, Kyle, but it's an option, right? If you're putting an offer on a house, you can always ask for a credit from the seller to cover the closing costs and the prepaid items. That is allowed on the loan. We got to make sure the buyer comes in with the down. The rest could be covered by a seller credit. So that is one option. They might not cover the whole thing. You might ask for 10 grand. They might give you 5. Might give you none, right? So the other option is a thing called a lender credit, where we give a credit to cover the closing costs. And how that works is, if the interest rate today is 2.875, what we do is we go up on the rate a little bit. If we go above the going market rate, we get a credit from the bank, basically. We get, by selling a higher rate, we get a credit. We can't keep that credit as part of our commission. It has to go towards the client. So basically, if we say, hey, today the rate's 2.875, you're going to need $25,000 to buy the house. Well, the client only has the 15 for the down payment. So we say, okay, we'll give you a rate of 3.125, and we're going to credit you the $10,000. So it's called a lender credit. It's different all the time. It depends on the market that day, what the rates are at. But we can sometimes credit all the closing costs and the prepaid items. And if you only have to come up with the down, let's say your interest rate goes up 0.25%, so your monthly payment goes up $60, but you don't have to wait to save up that additional 10 grand, right? So again, with the rates as low as they are, even if you took a higher rate to cover your closing costs, you're getting a super low rate, like a rate that's lower than it would have been 6 months ago, even if you paid money to buy it down. You know what I mean? So the rates are great. So that's another way that you can do it. The down payment for the buyer needs to be their own money out of their own bank, checking, savings. It can come out of a 401k or a retirement account is fine. Or it could even be a gift from family. So if you don't have the money at all, but your dad says, hey, I'm going to help you buy your first house, I will gift you $15,000. 100% of that down payment and everything can be a gift from family. So
how many gift
another way to go.
Can you guys do?
How many gift letters?
Mm-hmm.
There's not a limit. So if you had like 5 family members giving you, hey, I'll give you 2, I'll give you 2, I'll give you 2. It's fine, as long as they're blood relatives, right? They have to be like mother, father, sister, brother. It has to be, a direct family member giving you the gift.
Okay.
Okay.
Danielle's got a question about 401k funds. How does that work?
Sure. So 401k, usually if you contact on your 401k statement, you'll have like a little financial advisor or phone number. So usually I'd recommend calling that number and just telling them you're thinking about buying a house and how much can you get out of your 401k. Usually you have 2 options. You can usually cash out some money, or you can take a loan against the 401k, which is more popular, and that's what most people do. So they're taking a loan against their own money. So if you have $15,000 in your 401k, usually you can loan or borrow 50% of it. So usually you can take out half of whatever's in there and use that for your down payment on your house. It's a loan against yourself, So what you're doing is you're on your next pay stub, usually you have a certain amount that'll go back to your 401k. It comes out, pre-tax, which is great. We don't count it as part of your debt ratio in your loan. So it's a super good way to buy a house, to use that 401k money. You're loaning against it. It's still accruing interest. It's still growing. You haven't, taken away from the dollar amount that you have, and you're using it to purchase a house. So yeah, super good way to go.
How about VA loans?
So VA loans are fantastic. So if you're eligible for a VA loan, some of the good, factors with the VA loan is that there's no money down. It's a 0 down payment loan. You don't have to put one thing down. Again, you can get a lender credit or seller credit to cover all closing costs and prepaid items. So you can get in with no money. There's no limit on the purchase price or the loan amount right now. So you can do $1 million VA loan with 0 down. One of the things that we maybe didn't talk about all the way is the monthly payment on a regular loan is, again, it's your mortgage, it's your property taxes and your insurance. And on a conventional loan or a FHA loan, there's a thing called mortgage insurance that's added to the payment. It's a type of insurance that the banks require that is on there because you are putting a limited amount of money down, and they got to make sure they have like this insurance coverage in case you foreclose on the house. So they're going to charge you a mortgage insurance amount monthly, and it depends on your credit score and how much you put down, but it could be $100 a month, it could be $300, it could be $400, depending on the size of the loan and your credit.
Okay.
So with a VA loan, there's no mortgage insurance. So you're literally just paying the mortgage, the taxes, and the insurance. So it's, super good way to go. Going to get a super low rate. The rates are great with VA, and there's no mortgage insurance. So
That's awesome.
yeah,
I
good
just
way.
looked at those too. It was so great for the clients. They were shocked.
Yeah.
It was great. Yeah.
I've had a VA loan where the buyer was buying the property and they got I don't remember the dollar amount, but they got a seller credit for a certain amount of money. It covered all their down payment, covered their closing costs, their prepaid items, and there was like $2,200 left over on a VA loan. That money was able to go to pay off the buyer's credit card.
Wow.
Get out of
So
here.
the buyer bought a house, put no money down, and got his credit card paid off through buying the house. It was crazy.
Wow.
Jesus,
Yeah.
I should have joined the army.
Made money.
I know.
Yeah.
God.
Ryan, I've got a question. So, we're talking a lot about mortgage insurance, and one kind of misconception that a lot of first-time buyers have is that they have to have 20% for the down payment. And we've obviously already talked about all sorts of financing options where you can put way less than that down. But the
Right.
reason why people have that 20% figure in their head is because that's generally the number that you have to come in with to avoid that mortgage insurance. But are there some,
Right.
we talked about VA, but are there other programs that are less than 20% down that avoid that? Or is it for the most part, you're hitting mortgage insurance if you're not at 20% down?
If you don't go VA, you're going to get some type of mortgage insurance if you put down less than 20%, but there's a thing called, it's self-insured basically is what it's called. So normally if you're putting down, let's say 5% and you're going to have mortgage insurance, you're going to get whatever the going rate is. And then we're going to charge you this mortgage insurance amount, right? But it's kind of works like the seller or the lender credit. There's a self-insured program where we go, okay, today's rate's 2.875 and your payment will be X, with $250 of mortgage insurance. Or we take a rate of 3.25 and you have no mortgage insurance. So you raise the rate up enough to buy out the mortgage insurance. So you take a little bit higher rate, but you eliminate the mortgage insurance. And the reason some people like to go that route is because first of all, your payment may be less, right? If you go up a quarter on your interest rate, maybe your payment goes up $60, but you eliminate $250 in mortgage insurance. So you've saved yourself $150 right off the bat.
Yeah.
Also, the interest is the part that's tax deductible, right? People don't like the mortgage insurance because it necessarily doesn't help the buyer with anything, right? It covers the lender and they cannot write it off. So that's why people go, I hate it. I don't want mortgage insurance. It still allows you to buy the house. That's why it's there. It's letting you buy the house with less money. But if you don't want to do that, you go with a self-insured route, and now you're paying a little bit higher in the interest, but you can write off that interest. So you're getting a write-off at the end of the year that's higher.
That makes sense. And you're
So,
also,
yeah, another good
you're
way to
also
go.
not stuck with the mortgage insurance forever. You can always refinance out of
Correct.
it, when it makes sense. So a lot of first-time home buyers, that's just part of the game is you're going to have some mortgage insurance for a period of time. But again, you know, with that example I gave earlier, the one you gave too, it just get in the game, you guys. Like, don't get it in your head that you have to save that 20%, because it's going to cost you so much more in the rent money that you're throwing out, the missed appreciation ride that you'd have. So yeah, I definitely just want to make sure that that's understood by everybody. And one more little note too. We talked about how you can have family help with gift funds for the down payment, almost like an upgraded family helping level. They can also co-sign. So if your income is, you know, just not at a level where to get the house that you really want, obviously you'd need to make sure you had some agreement figured out on how you're actually going to come up with the payments. But let's say mom and dad have really good income, or they're sitting on all these assets, getting them to co-sign with you would absolutely help kind of bump you up into a higher tier that you're really looking for. And then, you know, with everything, we always tell our clients, like, when you get pre-approved, the lender, they're telling you like what the max that they're willing to loan you, and you know what that looks like from a purchase price standpoint. But then it's up to you guys to tell us what the budget is. We have a lot of clients who are very comfortable financially, like maxing out at their pre-approval amount. And then we have other clients that don't want to go anywhere near their pre-approval amount. You know, they want to save the money for other things. So it's really important that you guys, when you're working with Ryan and Bryce and talking about getting pre-approved, make sure that you're communicating like what you're comfortable with paying on a monthly basis too, because you know, that's a huge factor. And I once got into an escrow where the client didn't really realize what the mortgage was going to be. I mean, the lender clearly had explained it, but the client, it just went kind of over their head. And we're a couple weeks into the deal and they're like, oh my God, I can't afford the monthly payments on this. And I was like, what the hell do you mean? Like, why are we having this conversation now? So that's just super important. You know, like, you guys understand your finances. The lender, they'll tell you what you can max out at, but then it's up to you to kind of help steer us with what the budget is from there.
Yeah.
All right.
Yeah.
Hey, Ryan, I have a quick question on FHA since
Yeah.
we've kind of been talking about that a lot. So what are the like main differences between, you know, FHA loans and then conventional loans, and why would someone use an FHA loan? Because I think like I get a lot of questions about it sometimes, like, you know, what about an FHA loan?
Right.
So maybe you can explain a little bit on that.
Yeah. So there's two main types of loans that everybody pretty much enters into. It's conventional or FHA. So they both have their own, you know, pros and cons for sure. So I know a lot of times people think, hey, conventional is better. Not necessarily, right? It just depends on that person's credit score and different things. So FHA is a government-backed loan. They're the ones that go down to a 580 credit score. So conventional, number one, does not. They're minimum 620. So if you're below 620, your only option is an FHA. So obviously it's it's better for you there. FHA requires 3.5% down. Conventional for the most part is 5% down. So that's a little bit higher down payment for conventional. FHA is kind of like if your credit score is 620 or above, the interest rate is the same whether you're 620 or 850. Right? So you're going to get a super good rate. In fact, the FHA rates are a little bit lower than conventional, so that's a benefit. FHA has the mortgage insurance that we talked about, and again, that's at a flat amount. So it's a flat percentage. It's 0.85% of the loan, whether your score is low or high. So they don't have any discrimination or change on the rate or the mortgage insurance if you're at a different FICO score. Conventional is the complete opposite. Conventional is all credit driven, so it's based on tiers. So conventional is a 740 or higher credit score is your top category. Every 20 points down is a different tier, and as you go down the tiers, the interest rate gets higher and the mortgage insurance gets higher. So if you're a client that has like a lower FICO score, you're going to get a way better interest rate and lower payment with FHA. Okay? If you go to a low FICO score and you're going to go with a conventional loan, that interest rate may, instead of being 2.875, may get bumped up to 3.5. The mortgage insurance at FHA is 0.85 no matter what. But if you're a low FICO going conventional, the mortgage insurance premium may be 1.3, right? It may be almost double. So all of a sudden your your mortgage insurance is double the cost of what it would have been FHA. So those are the biggies. So when we're pre-qualifying somebody, we kind of look at all the, you know, credit score, like I said, all that normal stuff, and then we'll look at it side by side. And sometimes people got a great situation, they can qualify either way, right? So we might send you a pre-approval letter as FHA, but they can go, you know, they could determine or decide what they want to do once they find the right house. So once we get the house, we go, hey, here's the price. Here's your two options. If you go FHA, here's your rate, your payment. If you go conventional, it's this. One of the downsides to the FHA is that besides the monthly mortgage insurance, it has a thing called an upfront mortgage insurance premium. So the government has a set formula there. It's 1.75% of the loan. So as soon as you take that loan, they charge you this 1.75% cost, but you don't pay it out of pocket. Like, you don't hand over any money, right? So they're going to take this amount and add it to your loan. So basically, if you were buying a house for $300 and you put down $30,000 and your loan was $270 with an FHA loan, it's going to be 1.75% of that. So they're going to add like $6,000 on top. So your loan would be like $276. So you finance it, but that's a charge, right? FHA charges you automatically this amount. Also, they require that the property be FHA approved.
Yeah.
So for a home, single family home and stuff, it doesn't really matter. Like, to be honest, it's almost the same as conventional, right? The homes, they're looking at normal health and safety hazards, just like a conventional appraiser is, and it shouldn't make really any difference. The only difference with an FHA appraisal is really chipping paint. They look at a property, and if it's got, you know, old paint chipped on the ground, that's an issue for FHA. They want the paint peeled or scraped and repainted. They feel it's a hazard for kids or something, that the paint could be picked up and eaten like it's candy and get lead poisoning or whatever. So that's one thing for homes. But besides that, it's almost the same. But with a condominium, the condo complex has to be FHA approved. So this can be a biggie, right? So if a client's out there looking for a house and they are FHA buyer and they want to put offers on homes, we have to look at each condominium and make sure that the complex is FHA approved. But what we're looking at there is we have to look to make sure that the complex has enough reserve money in their budget. We have to make sure that they don't have any litigation on the property. We got to make sure that they have over a certain percentage of the units owner occupied. So as you're out looking, we just got to be conscious of that. You guys are showing an FHA buyer some homes and you say, hey, they like these three. You would usually email us and say, hey, is this condominium complex FHA approved or not? If it's not, that eliminates the chance to even put an offer on it, you know, unless we can change it to conventional. So the biggest difference is probably the condo purchase.
Thank you.
Does anybody have any questions like on loans, like just in general, like anything about financing?
I have a question they may not know they need to ask.
Let's hear it.
If you go FHA, is that gonna, you know, deter the seller or the listing agent from accepting you versus a conventional loan?
I could answer that.
Well, you guys will know, right? It could, right?
Yeah.
Yep.
Yeah, I mean, it depends. It really depends on like the property, because
Right.
we actually had one earlier this year that we went FHA, and in the middle of the deal, we did have to scrape the paint and repaint it. So and that was something the listing agent was concerned about. The way that I countered that was I just said, look, if that's what they come back with, my clients, like, they'll just even pay for it themselves. And they did. I of course had the conversation with them about it, but they were like, Kyle, don't let us lose this because we're FHA. So, you know, if you're a listing agent and you know that might be an issue, maybe. Generally, like Ryan was saying, if it's a home and it's in decent condition, it's probably not going to make a huge difference. Probably not. Yeah. All right. Well, sorry, Ryan, go ahead.
No, that's all right. I was just going to say, I think agents, maybe we come across this a lot, right? That they probably have like a hierarchy of what they think is like the best buyer on a property, right? So if you're listing a house, you got a cash buyer, there's nothing that can get in the way, right? So that's the best usually, right? You got somebody that can close super quick. They don't have to wait on a loan approval. So usually that kind of falls first. Then than agents like conventional because they feel like, hey, the person's got more money, they're putting more down, they're probably more solid. Then it usually goes to FHA, and then usually goes to VA, I would say, right? That's probably where the agents fall. VA, no, they're not putting any money down. People get scared. It really is more of just people's thoughts on what's stronger and what's not. Because like I said, half the time, an FHA loan might be easier to close than a conventional loan because they don't look as they're more lenient. They're not looking at all the stuff like a conventional loan, right? They could have lower credit. They could have some issues with their credit. They could be shorter on the job, but the FHA buyer, the underwrite on it is less strict, right? So a lot of times the FHA buyer might be an easier close than the conventional buyer. Also, that's where the quick timeframes come in, right? Because the agency, an offer that's got financing, they know it's got to go through all these hoops, right? An appraisal, a background check. It's got to go through a lot of stuff that could derail it, right? So when they got a cash buyer, they're like, okay, how fast can you close? Well, I can get the cash, I can turn around, I can be done in 12 days. Mm-hmm. So when we come in with a finance buyer and we say, hey, well, we can close the finance buyer in 17 days. Sometimes that's almost as fast as cash, right?
Yeah.
Because that's what makes it look strong. We're looking at everything ahead of time. We already got all the pay stubs, the documents. We may have even underwrote the file, but that's why you can move so fast and push your FHA buyer from being, at the bottom of the totem pole right up to like a cash buyer almost. You can go, these two other have financing, but they need 60 days, right? They need whatever. The banks and stuff right now are running they're so busy that turn times are just becoming outrageous, 2 months, 3 months. So when you're coming in with a great buyer, but they got to take 3 months to close or 60 days to close, and you're coming in with somebody less money down, but they can close in 17 days, obviously that helps you get the house over even having to offer higher sometimes,
Totally.
It could be at the same price, but you're going to go faster. So that's where that helps a little bit.
Totally. Yeah. Cool. Well, let's shift gears here. I really appreciate everything you're talking about with loans, Ryan. And you guys, if you have more questions, you can just type them in the chat box. And then Bryce and Ryan, if you guys want to stick around, that's totally cool. Or if you guys are trying to get home to dinner with the family, that's cool too. We could take it from here. So totally up to you guys. But yeah,
Okay.
let's shift gears and just kind of talk a little bit. I'm sure everybody right now is thinking about this little thing called coronavirus. And
I'm going to drop off real quick, guys, just like since you said that. Nice meeting everybody, but I do have to run. So I'm going to drop off and hope to pre-approve somebody here shortly. All right?
Yeah.
excellent. Thank you,
I'm
Brian.
probably gonna
All right.
Bye,
I'm probably
Brian.
gonna drop off as well, but I did want to leave you guys with just a couple closing remarks. We gave you guys a ton of information today, and a lot of it was very detailed. We don't expect you to remember or know all of this. That's why me and Ryan are here. We're basically your advisors throughout this process. Like he said, getting pre-approved does not cost you anything other than some of your time. So we're going to ask you what your goals are, and those become our goals. And if you're not quite ready for what your goal is, we're going to put you on a path and tell you the plan to get you prepared for your goal. And again, that doesn't cost you anything other than some of your time. And we're happy to help with that anytime. So use us as a resource. We'll chat with you about whatever your questions are.
Yeah, 100%. And just to kind of reiterate, like we got super in the weeds and technical there, but it's kind of like, to drive a car, you don't need to know how every engine component works necessarily, but it's interesting and it definitely helps you kind of wrap your head around it. But when you guys get to the stage, you're going to talk to them and show them your finances, and they're just going to put everything in front of you all clean and laid out. So if like you were just getting lost in percentages and all that stuff, like we just kind of pop the hood and show you how it works, but you guys don't need to worry about any of that stuff really.
Yeah.
Yeah.
Thanks,
Cool.
guys. We really appreciate it. Thank you for everything.
All right.
Hey,
No
guys.
problem.
Yep.
Have a
See
great
you
weekend, guys. All right,
All
bye.
right, guys. Hope to talk to some of you soon.
Yep.
Will do.
All right. So good old coronavirus. It's something that like every single client conversation that we have, this comes up, is how is it impacting the market, and where do we see just what are our projections really? Because there's a lot of people who are of the mindset that we're going to have a big crash in the upcoming months or top of 2021. And then there's a lot of people who don't think that. So we'll kind of get into all that a little bit and just kind of give you our own philosophy. But before we get into projections, let's just talk about the market right now. So it's weird because like the economy is having all these problems. You see unemployment is higher than it's really been. But the housing market is just really thriving right now. And that's kind of counterintuitive. But the reality is that with interest rates as low as they are, it's just so enticing for buyers right now to get in the game. And then you have just a limited, basically, amount of inventory, meaning that it's going to be competitive and there's just not that much out there. Now, because you're going to have competition, that doesn't mean it's a bad time for you to buy it. It's an amazing time for you to buy because of all this, because of these low interest rates. So you guys are in the right place. Your timing is really, really, really good. And yeah, but prices are strong right now. They are not going down. So let's talk a little bit about projections. We personally do not think that we're going to see a big dip. Howard, I think you like locked your image, by the way.
Am I still locked?
I don't know. Let's see. Oh yeah, I think.
Maybe my internet just sucks. My internet's got
everybody.
coronavirus,
Let me see.
I'm sorry.
There we go. So yeah, like with the direction of COVID, a lot of people are worried that we're going to have a big like round of foreclosures coming up down the road, which would change the market. And here's why we don't think that's the case. So you have like Ryan alluded to this a little bit earlier, but talking about the mortgage forbearance, where the big banks right at the start of COVID, they said, okay, we are not going to penalize you if you don't pay your mortgage for 3 months. And everyone was like, oh, that's great. But then what happens on month 4, which is kind of where we're headed into now. And that was what was scaring everybody, was because it's like, okay, these people are going to get hit with a 4-month mortgage bill. And if you're on a fixed income, that's just going to be something that people aren't going to be able to do. Then the banks are going to foreclose. We're going to have all these problems. But that's not going to happen because Fannie Mae and Freddie Mac, they're kind of like at the absolute top of the food chain of the mortgage industry. And they've said, look, we don't want mass foreclosures. That's not good for anybody. We're going to just be nimble and work with the borrowers on an individual basis and just figure out ways for them to be able to, to pay it. So maybe they'll just stick those 3 months at the end of the term of the mortgage, or maybe it'll be spread over like a period of time where you're making increased payments off. So they really, really, really were emphasizing that they're not going to be looking to just come down really hard on people. So that's definitely encouraging. And, there might be dips that happen in other parts of the country maybe, but the prime kind of LA markets, they're just in such high demand, and there are far too many people that just aren't being impacted financially by COVID, that I just really, really don't see prices taking a dip in our kind of, LA markets that we're seeing here. And, when you think about it, like the rental market right now is depressed. And so you're seeing all sorts of incentives to get people to lease, because the renting population, like when you think about who COVID's impacting, and this is really broad, obviously, a million exceptions, of course, but, a lot of restaurant workers, a lot of people who work in retail, venue workers, they are probably more likely to be a renter than a homeowner. So, and there's just like a lot of high skilled jobs that are not impacted. That is why people are projecting for LA to just stay really strong, which means that it's just a really, really good time to get in. And, I always think it's important though to play devil's advocate here, and let's explore the scenario in which I'm completely wrong. So let's go there. You guys get a house in the next like few months. and then the economy just continues to get worse, and the housing market starts to go down. That obviously is less than ideal, but it really is not going to make a difference, really. I mean, sure, it would have been nicer had you timed it, but timing markets is somewhat of a fool's game if you think that you are going to do that consistently well over time. With real estate, it's like just get in and then ride it out, because yeah, so let's say you get your property and then the market goes down. You're not going to sell your property anytime soon, you guys. It just doesn't make sense. Like if you're not sure you're going to be in your home for more than 2 years, you probably shouldn't buy, because if you're in it for less than 2 years, you're going to pay much higher tax when you sell, because they treat you like a flipper. They think you're doing this as a profession. And you also, the seller is the one that pays the realtor fees. By the way, you guys as buyers, we work for you for free, so yay. But it's expensive for the seller to pay both sides. So unless you actually have decent appreciation in your home, you're going to lose money basically. So yeah, you statistically will be in your home for probably about 5 years before you move. And let's say you even do it sooner than that. Let's say it's like a 3-year plan. Even if the market goes down because of COVID in 2021, which again, we don't think is going to happen, but if we're wrong, it will have rebounded by the time you guys are ready to sell. So it's just like the stock market where, if you are holding on to your asset, yeah, it hurts to like see, oh my God, the value's gone so far down, but you just don't sell when it's low. You wait and you ride it out, and you ride that appreciation coming out of it. So, and just with interest rates where they are, they're not going to be this low years from now. So I just really, really, really am passionate that like now is as good of a time as like, I've really seen in my career. I mean, sure, coming out of the 2008 crash, that was a great time too, but it's just, I think, a really good time, you guys. So does anybody have like any questions regarding like COVID and how the market is now and how things will be moving forward?
Kyle, I have a question. This is
Yes.
sort of going back to the loan thing.
Okay.
Once you get approved for a loan, is the interest rate that you're approved at locked in? And also, how long is that valid for?
Great question. So you're not locked on your interest rate until you open escrow, and then you'll lock it during escrow. So yeah, and that's really important, especially in a time when rates are fluctuating a decent amount. Because if you talk to one lender on one day and they give you a rate quote, and then you talk to another lender, a couple weeks later, it's not necessarily that the other lender had better rates. It might just be that the market has fluctuated. So that's yeah, the rate doesn't lock until you're actually in the deal. And then pre-approvals are valid for about 90 days. And it's not super rare, it's not uncommon for your search to take longer than that. And if we exceed that 90 days, it's as simple as they just check your credit again, and you might send over like an updated bank statement or something like that. So, I get a lot of clients who are a little uneasy about starting the pre-approval process because they think they're on the clock to buy a home in 90 days, but that's just not the case. It's not a big deal if we have to renew it. And it's just such a good starting point to have that conversation with them, because even if you're not quite there yet, they're going to give you a path and put a game plan together on how to get there. So it's definitely the kind of thing where even if this is a plan of yours for like a year down the road, have that dialogue with them, see where you're at now. You might be surprised. You might be like, oh, wow, I can afford more than I thought. Or you might be surprised the other way. And again, for self-employed people out there, like it might be the case where like you just didn't quite realize that they look at your net rather than your gross. And so you might just want to strategize and put a game plan together for, a way to get that better. Okay, I think I just figured out how to fix the spotlight thing. Sorry, Brosh, that was on you while I was talking that whole time, but you did great.
Right.
Cool. Does anyone else? Okay, we got Phil has a question here. Is there a worry that high unemployment as well might be less helpful stimulus will continue to force deferment of mortgage payment, and the buildup of deferments leads to breaking point. It could, like, the longer this goes, obviously, and if the government doesn't continue to come up with ideas, there for sure will be some people who are really gonna be hurting. But again, it's like we're talking, like, the housing market is about homeowners. It's not about the economy at large. So I think statistically we'll see less of that, but if it keeps going and keeps getting really bad, we will see that. But with demand as high as it is, and inventory right now is just choked, absolutely choked. So the market has the capacity to take on, more inventory, but I just don't see it being this thing where the market is flooded with inventory, which will reduce prices. For Los Angeles. For other parts of the country, that could certainly maybe be the case, but for prime markets in Los Angeles, that's my opinion at least. All right. So let's talk a little bit about just the overall kind of process here. Step number one is educate yourself. So great job, everybody. You are in the middle of that right now. Little pat on the back, y'all. And then step number two is to figure your financing out. So Ryan and Bryce just, again, they got really technical on all the stuff, but your takeaway should just be the following. You don't need to put 20% down. You can put as little as like 3.5%. If you're in the military, you can do 0. So that's a big one. Family can help, whether they co-sign on it, where their income and assets will factor in, or they contribute with the down payment as a gift fund. That's really what you need to take away from there, basically, because then you're just going to have a meeting with them. They're going to send a list of all the stuff that they need to get you pre-approved. And then they're going to do all the number crunching for you and just tell you what your options are. Maybe it might make sense for you to put a little more down, a little less down, and just really customize the right kind of loan package. And again, they're going to give you a max pre-approval amount, and maybe maybe that max pre-approval is where you want to go, or maybe it's going to be lower than that. And so you'll take that number, take it to us, and we will then talk to you about the different options at your price point, the different neighborhoods. I mean, nowadays with Zillow, like, y'all probably just poke around and have a decent understanding already of like how far your money goes in different neighborhoods. But, you definitely want to be working with realtors who really understand the markets that you're interested in, knows kind of like some upcoming new additions to the neighborhood that might raise property values. Just, it's definitely important that your realtor does have kind of their finger on the pulse, and so they can lend you that level of expertise. And so you'll put your search together, and then everyone will kind of be sending properties back and forth. Because again, with Zillow, you guys are seeing the same stuff we're seeing for the most part. And of course, we'll start touring places. With COVID now, you actually, for the most part, you need a pre-approval to even just see houses now, because listing agents want to reduce the amount of showings, obviously, because it's COVID. So they force you to, for the most part, some aren't, but in general, you can't even really start seeing places until you have your pre-approval. So, but anyway, you'll see some places, you'll pick out, okay, I really like this one, Kyle. I'm really considering an offer on it. So what we do from that point is we will run comparable sales. We want to see how this property compares to other properties that are similar to it that have sold, because the agent and seller could have underpriced it. Maybe they overpriced it. We want to get a sense of market value. And then we really want to put a strategy together. And the only way to put a good strategy together is to really dig in. This is what the buyer's agent does. We really dig in with the listing agent to try to figure out, okay, what is the seller really looking for? I mean, obviously they want the most money, but are there specific terms that we could structure it to make it more appealing to them? Do they need a long close, a fast close? Just really try to cater to their needs, because if it's competitive, which at the first time home buyer price point, it's very competitive. We're trying to win a beauty contest here. That's really what it comes down to. So that's a big factor. We want to know, are they looking at offers as they are submitted, or what a lot do is they'll just wait and they'll say, okay, offers are due maybe like 10 days after it first hits the market, and they're just going to sit on the offers they get, and then they're going to issue a multiple counter offer to whatever offers they want to. Sometimes they counter everyone, sometimes they just pick the best to counter. And generally, when they send that counter offer in a multiple sense like that, it says purchase price to be best and final, which sucks because you guys are like, what the hell does that even mean, best and final? You don't want to overpay for it. You know, in a perfect world, you'd pay just barely a little more than your next competitor. But when it's blind like that, it's really hard to nail that. And so kind of like what I was saying at the top of this, that's where having financing that can close in 17 days and remove all contingencies, we'll get into contingencies in a little bit. Listing agents and sellers just love that. And we love representing buyers that have it because it's almost like cheating. We you know, oftentimes the listing agent will steer us and will just kind of tell us like, hey, you know, like your guys' timelines are just amazing. Like here's the number that the next highest one came in at. If you beat that by a couple grand, it's yours. And so that is awesome. We can't guarantee that. It doesn't happen every time, but certainly does happen from time to time. And boy, does it feel good.
And Kyle's like a wizard with that for some reason.
I'm quite good at winning in those and
It's
just
very crazy.
getting like, even when listing agents don't want to tell me what the competition looks like, I'm really good at still figuring that out.
It's really weird. It's like he can translate all their objections and he's like, I know exactly what's going on. I'm like, what? That's crazy.
Yeah,
Our buyer
we're
like, oh, it's he.
we're pretty darn good at representing buyers. There's no
for
doubt
sure.
about that. All right. So then our offer is accepted. We are super stoked. Yay. What a moment. That then starts the escrow process. And this is a huge part of the home buying process. And escrow is basically the period from accepted offer to the close of escrow where title transfers to you and you get your keys. And the main point of escrow are for your loan to kind of just go through the cooker, like, and actually go from a pre-approval to can you guys hear me?
Yeah.
Okay, good. To go from that pre-approval letter where they're saying we're confident that we can issue you this loan to then close to the end of escrow, they're like, okay, like we're ready to issue you this loan. And during the escrow, they will scrutinize your finances. They're going to call your employers. Like they just really, really vet you financially during the escrow. And so that's a big part of it. The other biggest part of the escrow is for you as the buyer to do your due diligence on the property. So what that means is we're going to do inspections. You're going to review the seller disclosures where the seller has to tell you, you know, any issues that they know to their knowledge. And that's a big, big, big part of it. So right when we open escrow, you guys are going to have 3 business days to send the escrow company a 3% earnest money deposit. So 3% of the purchase price, you're going to have to wire over to escrow. And they hold on to that money to ensure that you guys as the buyers play by the rules of the purchase agreement. And what that means is that if you want to back out of the deal and you expect to get your money, that earnest money back, you need to do so using one of your contingencies properly. And so your main contingencies are the inspection contingency, and I'll explain that in a second. Appraisal contingency, that's loan related, and then loan contingency. Those are your main ones. And as Ryan was saying, they can, and the loan is the longest, and they can remove all contingencies in 10 days, where most of our competing offers are 21-day loans. Mm-hmm. So another just big kind of, you know, advantage that we have when we work with them. Okay, so let's go through those. So inspections, that's really your biggest contingency because it can be applied the most liberally. What I mean by that, and I'm not really supposed to say this, but it's kind of true. Like even if you just change your mind and just don't want the home anymore, if you have your inspection contingency, it's really, really, really hard for the seller to make a fight that like they should keep some of your earnest money deposit. So yeah, as long as you have that, you just use your inspection contingency, you can walk away. But that's not really the point of it. It's not for you to change your mind. You hopefully are feeling all in on the property when you submit the offer. The real point of the inspection contingency is for you to inspect. And what that means is if it's a single family home, we're going to start with a general inspector who looks at just about everything, a termite inspector, and a sewer line inspector. Those are the three that we start with. And then if the general inspector says we need more, like if the roof is in bad shape, we need to get a roofer out, we'll get them out on a separate day. But those are the three that we start with. If it's a condo, by the way, we probably only need to do the general because the HOA covers the exterior and sewer and all that. And so as we're doing our inspections, we are kind of racking up a list of problems with the home. And then we're gonna renegotiate basically with the seller. We're gonna say, hey, for us to stay in this deal, we want you to either fix or pay for, credit us money for us to do it for these issues. And then there'll be probably a back and forth, and this is a really escrow. And hopefully we come to terms with seller you bit about transaction based on what the problems are and how willing they are to accommodate them. So once we remove your inspection contingency, the remaining two are appraisal and loan. The appraisal is where the bank is going to hire a third party to go out and just basically weigh in on what they think our purchase price is. Because keep in mind, if you default on your mortgage, it then becomes the bank's property, and the bank wants to make sure that they're not overpaying for it. So hopefully the appraiser says, yep, we think your purchase price is good, and we can just move forward. If they say that we're overpaying a little bit, there's a bunch of things that we can do to still keep the deal together. That's a whole can of worms, though. I don't really want to open that right now. And then we've got the loan contingency. That's normally the one that you'll have the latest in the deal. And kind of like what Ryan was saying, do not change employers during the escrow. That can screw a deal up. Don't also take on new debts. Like, don't go out in the middle of an escrow, like get a new car. I always make a joke, like, don't buy a boat, but like, don't get a new car. That's probably more realistic that people would consider, because like he was saying, they look at your debt to income, and if you are taking on a new expense, that's going to shift your debt to income, and you just don't want to do that. So generally speaking, though, as long as you stay pretty just disciplined in a financial and vocational standpoint, we rarely have issues with the loan contingency, but we definitely it's there, because if the lender screwed up pre-approving you, you don't want to lose your deposit just because at the end they're like, oh shoot, like we actually can't issue your loan. So you'll keep your loan contingency until they say, all right, you guys are good to remove it. Like we can issue you loan docs, basically. So that's the next step. They issue you loan docs. You'll sign the loan docs. Then you'll put the rest of your down payment and closing costs in. And then the next day, the loan funds. And then the next day, title transfers over to you. It records, and we come over. Pilar will take pictures and give you gift baskets and all that good stuff, and some champagne, the whole deal.
Pop champagne if you're down.
Yes.
That's our favorite part, as you can imagine.
Yeah. All right. So does anybody, do we have questions on the just general home buying process, escrow, inspections? Let us know if you got any questions. Ooh, we got, how often does the appraisal contingency lead to a back out? Not that often. And I'll explain a little bit about what we can do if it doesn't appraise. So, and this is actually why sellers prefer offers that have higher down payments. Because if, let's say you're putting 50% down, if the property doesn't appraise, that doesn't affect the loan whatsoever. That's more you as the buyer, you might say, ooh, I don't feel great. Like, I think I'm overpaying for it. But the loan amount is for only half of the value. So even if they're saying, oh, you're paying, $25,000 more than we think it's worth, your loan is completely unaffected. So, but if you're at like 3.5% down, and it doesn't appraise, you're kind of screwed at that point. So that's why sellers, if you have two offers that are the exact same price, the seller will always pick the one with the higher down payment, just because if there is an appraisal problem, the deal can still move forward. So yeah, that's just a little bit of something there for the appraisal. But let's say you're at like 20% down or 15%, where it's kind of hit or miss whether the lender will say, okay, it didn't appraise, but we can still either just move forward with your loan, or sometimes they say we can't move forward. You need to close a gap. So let's say, yeah, it appraised 10,000 under, and the lender was like, we need to close that gap at 10,000. We'll of course first ask the seller to reduce their purchase price by 10,000, but they probably won't, but we'll try. If they don't, what often you see happen is maybe we can get the seller to like split the difference with us, where you'll put in like $5,000 more towards your down payment. You're not putting in $5,000 more on top of the purchase price. You're just kind of putting in a little more of a down payment, because the bank is saying we can only loan you, a little smaller amount because it didn't appraise. And then the seller will reduce the price by $5,000. So again, there's all sorts of stuff we can do. We got a question about referring out in Oregon. We absolutely can put you in great touch with people in Oregon. Just let us know the city and we can certainly help with that.
Absolutely.
So yeah, any other questions about escrows or the overall process?
Kyle, since you were talking about appraisal,
yeah,
for buyers, we don't want our buyers to overpay for homes. So anytime we, identify a property that they want to submit an offer on, we will always do comparable sales and look at what's sold, nearby in the area and recently, so we know that you're paying market value. Because we'll always tell our buyers this, but list price sometimes doesn't mean anything. They can underprice the hell out of the home and draw up a crazy bidding war. They can overprice it, and that's when you see a lot of times a home will just sit on the market because no one's really willing to pay that. But that's why it's important for us and to work with a good buyer's agent to look and analyze the list price and make sure you're not overpaying.
Totally. Because yeah, exactly. We do our own appraisal when we run our comparable sales, basically. And that's why sometimes if the appraisal doesn't come in at value, it's more of something where we're frustrated with the appraiser, because we've looked at our own comparable sales and we feel good about it ourselves. Then if they're like, well, we think you're overdoing it a little, you could have 3 appraisers come in with 3 completely different values on a home's worth. It's my least favorite part of real estate, actually, because so much is riding on this one person's opinion. And, depending on what comps or comparable sales they're pulling, maybe they're just pulling not the right ones. We always do our best to kind of show these are kind of how we came to our the comps we use to do it. And sometimes they accept them, sometimes they don't. But yeah, it's a whole thing. But like Howard said, it's not like we're going to go into writing the offer without doing our own kind of homework on value and everything. And of course, like Howard said, we do not want anybody overpaying for a home. We want this to be an investment vehicle for you. And if you overpay for it, it's going to take longer for you to start getting your good return on it and that equity. So any other questions before we shift topics here? All right, let's jump into a little neighborhood discussions here. And yeah, if anybody wants us to talk about any specifically, please throw that in, but I'll just do a quick little screen share here. Okay, so here is our beautiful city. And we'll just talk a little bit about some kind of more emerging pockets. And but having said that, let's say you really want to buy a place in Santa Monica. That is totally fine. Santa Monica is not emerging whatsoever. It is at the top of kind of the food chain in Los Angeles. But if you buy a place in Santa Monica, that still is a good investment. Like it will still appreciate in an appreciating market. So like definitely go for that. And, you know, some clients ask too, they're like, well, what neighborhood would be the absolute kind of best, you know, to invest in and from an appreciation standpoint? Like I can tell you neighborhoods that are super on the up, but you know, it's going to be up to you whether like from a lifestyle standpoint, that works for you. Like maybe it's a little more important for you to be walking distance to your favorite little cute cafes and whatnot. Cause like the more emerging it is, like the probably more different it's going to be from where you're currently renting right now. And, you know, the things that you like. So it really just comes down to a personal standpoint of like what really your goals are and what really is important to you from a lifestyle standpoint and everything. So just kind of wanted to throw that little caveat in there, but let's talk a little bit about Northeast LA. We do a ton of business out there. And it's the kind of thing where, you know, there's so many different kind of molds of buyers, but one is somebody who is renting over here, like on the east side, and they love renting here, but when it comes to purchasing, they're a little priced out, but they can afford over here. So there's almost this like you rent here, you buy here kind of like mass movement. And it's, you know, it makes a lot of sense. Like these are very much emerging. Highland Park has been just killing it for a while now. And you have like the great little stretches of York here. This is really, really highly concentrated with like cool restaurants and cafes. This section here has, over the last few years, really emerged. There's that Barcade and a bunch of other cool stuff that has come up a little further down. And then Fig too, you've got like Highland Park Bowl and a bunch of really cool stuff along here. So super commercially developed already. You know, I'd say Highland Park, Eagle Rock, and Mount Washington are like the top kind of tiers. And then you have Glassell Park, maybe one tier under, so a little more affordable. I just love like this from an investment standpoint because Frogtown here, this is Frogtown, the area between the 5 and the river. So right here at Rio de Los Angeles State Park, am I supposed to say Los Angeles or Los Angeles? I always like feel like an asshole as a white person when I say it that way. But when you say, I don't know. Anyway.
Do you, boo-boo? It's 20.
I know. So this is where the Frank Gehry LA River Revitalization Project is going to be headquartered. And I think it's $2 billion that is carved out for this project. And you are actually going to be able to come here, rent freaking kayaks and like kayak down LA River. It's going to be super cool. And it's just going to really just continue to boom, you know, the Northeast LA neighborhoods and markets. So like, yeah, you know, Highland Park has already transitioned a lot has transitioned, but I do still think that in large part because of that project that we're just going to continue to see appreciation percentages probably a little bit higher than like LA as a whole. So a few other neighborhoods that are really popping, like the neighborhoods surrounding USC are on fire right now. Like really, really good values. Jefferson Park, Lamert Park. There's just a lot going on. Like the university itself is making a big effort to kind of like hop on the downtown boom. And so they're investing a lot in the like commercial establishments that kind of connect it up to downtown. You've got the new like Bank of California soccer stadium where LAFC plays. Just a lot of cool stuff going on here. So yeah, a lot of first-time home buyers are getting affordable homes in these neighborhoods, and we certainly expect to see good appreciation there. Some other neighborhoods.
Hello.
Oh, sorry.
I have a client friend that I helped buy a home down like Normandy and Slauson area.
Oh,
2 years ago for like $370, and she reached out to me. She's looking into buying a second home, so she's already got $150,000 in appreciation.
Oh my God.
Yeah, and she says like there's so many houses on her street that are just being flicked all over, getting flipped.
Yeah. Yeah, that's how you know a neighborhood is really on the up. It starts with the residential development where like just house by house, people come in, they flip it, and but then it takes a little bit longer to see the commercial development start emerging, which is actually quite a little segue to West Adams, because commercially there are stretches that are pretty developed now. They've been flipping homes in West Adams for a while now. So this is, what we're looking at here, just south of the 10, like kind of mid-city south of the 10. From Hauser to Redondo. So this little stretch right here, I was driving by it the other day and I was absolutely blown away because it was a pretty high concentration of, like the cute little cafes, the restaurants. There even is a vegan bike repair cafe there, which it's like you could pick that up and stick it right in Silver Lake. And I was like, oh my God, West Adams is about to explode. So yeah, we really, really like, this part of West Adams, especially from just an investment standpoint that we'll appreciate more. There's just all over Inglewood with the stadium. Inglewood's huge, first of all, but I think like certain pockets are definitely going to be appreciating really well. The west side is pretty darn expensive, but like I was saying, if that's just where you like living, it's still, get a place over there and you're going to make good money on it because it's still going to appreciate. We're just kind of throwing out some neighborhoods that might appreciate, there might be a little higher ceiling. So I could go on, but like maybe, Northwest Pasadena, there's a lot of great opportunity, like that property I showed at the start of this. So we're certainly open to like having more one-on-one conversations with you guys about the little pockets that you're interested in. And then of course, once there's like a finalized budget, then we can really kind of be like, ooh, well, like, you should keep this neighborhood in mind or this. So definitely something you want to have a conversation with, real estate agent about.
Especially when you guys are talking about lifestyle and things that you want to do, and maybe your job now is remote and you've always wanted to live in certain pockets or try certain areas. Like Long Beach is fantastic. You're by the beach. It's like a city by the beach. It's great. Really up and coming neighborhood. San Pedro is really coming up now. So there's some really great areas now that, especially again, if you're working remote and you have this time, you can actually live in the places you've always thought, I can't live here because of work. Now, maybe you can. So we're definitely having those
conversations. Long Beach too.
Long Beach for sure. Yeah.
Money will stretch out there.
Yep, absolutely. So
like parts of Long Beach are really nice. Yeah.
Absolutely. And it's cool. The lifestyle's cool. 4th Street's awesome. Lots of really cool cafes and restaurants. You're right by the beach. The lifestyle's very beachy. You're really close to Redondo and Manhattan and Hermosa. So it's just, it's a hop, skip, and a jump away from those great areas. So imagine that, those are definitely things that we would love to talk about because it's so much fun for us to kind of dive in to see what your lifestyle is and how we can just find you those great properties too.
Yeah. Does anyone have any questions on like anything we've gone over so far before we kind of shift into our final phase here?
I have a quick question.
Yes.
Sure.
I am like a total noob to all of this. I've only just started digging in, and one of the things that came up in terms of neighborhoods is our HOAs. Are those like static, like which neighborhoods have HOAs in place, or like what's the deal with those? Because like I'm hearing that those are like not something that you want to.
Well, HOAs, it's rare that you'll have them with single families. But sometimes, we're from Calabasas, Emily. So like there are certain like home communities in Calabasas had HOAs. It is very rare to see that in the city and east side, west side, or if you're in like a private gated community or something, you'll probably have HOA fees.
Right.
But in general, we don't really see those unless it's a condo or townhouse community.
Okay, but like general Northeast LA, it's not really something you.
Yeah, I've never seen. Yeah, but, if it's a condo, you're gonna have an HOA, and that's not gonna be like neighborhood specific. It'll just be specific to that complex.
Gotcha. Okay. Cool.
But yeah, no, that's a good.
That was just like a new concept
Yes.
that I learned about. I was like, oh no.
Totally.
But
Uh,
are you also like? I missed that. Sorry, because my husband came in. But was it only for single family that you were coming across for the HOA? Or are you also considering condos and townhouses? Emily.
Wait, sorry. Okay. Oh, was I? Oh no, I just like didn't even. The whole world of real estate is new to me. So just like HOAs in general, I didn't even know that those existed or what they were. So
Right.
Yeah.
Right.
I was just wondering if that was a common thing in like the specifically Northeast LA where I'm.
Yeah, no, we're not gonna see that in Northeast LA, really.
Gotcha.
No.
When it comes to like townhouses though and condos, I used to have this preconceived notion that HOAs were kind of a bad thing because it's an extra amount that you have to pay on top of your mortgage. And then I like moved into my family house and I have all these expenses like gardener, paying water, paying trash. Whereas when I was living in apartments and condos, I wasn't paying for those things necessarily. And that is something that your HOA takes care of. So when you kind of outweigh the costs, sometimes having an HOA, if it's reasonably priced, can be more attractive than actually homeowner, like a single family home,
Got it.
because you have all these like a gardener, and then if you have a pool, you have to maintain the pool, and so
Right.
it's
Yeah.
something just to keep in mind. It doesn't have to be a bad thing if you're looking at what you're getting.
Okay.
Yeah. No, that's a question that I get a lot, are people who their budget is really more steering them towards a condo or townhouse, but they just are so against the notion of HOAs. And, somebody probably told them at some point too, like, oh, well, a single family home is a better investment. I think the reason why people would say a single family home, if you're really comparing the two, is better is because they can appreciate a little more aggressively than a condo. And here's why. Like, if you're in a 180 unit condo complex, it's, when people are running their comparable sales and when appraisers are looking at it, they're going to have a cookie cutter example just like yours that sold, maybe like 3 months ago or something. So it's harder to really like push the value up because you're kind of a little more slowly anchored with all these comparable units. But if you're on a residential street in the neighborhoods we're talking about here, where they're not tract homes, they're all different, they're different shapes and sizes. You could have your neighbor down the street just fucking kill it and get like the best value, and that will impact like your home a decent amount, even if your home is a bit different from it. So that's a reason sometimes why people say single families are a little bit better of an investment. With condos, you also need to just check if you will eventually want to rent your unit out. You need to make sure that the HOA allows for you to rent it out. Generally speaking, banks won't lend on condo complexes if more than 50% of the units are rented. So that's where, like, if you're in a bigger complex, that's really good because it's really, really hard to, in that 180 unit example, it's really rare that 90 of the units will be rented out. But if you're in like a tiny little 4-unit townhome complex, getting to that 50% threshold is a lot easier to get to. So that's, just something to consider. Is it important to you that once you're done living in it, you want the option to either sell or rent it out? If that's the case, then we need to just make sure that HOA does allow it. And most of them do. See you, Brosh. So yeah, condos, like Pilar said, though, you really do have to take into account that, like, what your HOA is going towards are things that if you're a homeowner, you're just gonna have to pay for yourself anyway. So I'm glad you brought that up, Pilar.
Okay, got it.
Cool.
Phil
go ahead.
asked me about Mello-Roos, which is a great question.
Yeah.
And Mello-Roos is basically, I think Mello-Roos really only applies to like new communities that they have to build, like infrastructure, like parks and I don't know, light, whatever it is. And it's usually like the new tract homes will have some sort of Mello-Roos. I don't know if you pay, Kyle, do you know if it's paid like quarterly or included in your monthly how it's paid out?
I think you can set it up. I think they're due on like a quarterly basis, but most people just kind of like property taxes. They would just prefer to just like impound it and have it paid monthly, and then it'll just sit and then get paid. Yeah, you're totally right. It's where like when the city was developed or the community was developed, a lot of the costs were not put on the developer at the time. They were put on the future owners of the property, down the road. So, you might have Mello-Roos stopping in like 2040 or something. And it's definitely something that needs to be taken into consideration. We're in escrow right now on a condo in Hawthorne, and this whole community was kind of just developed and funded with money via the Mello-Roos way. And, the client, I had to say, look, this is a cost that you need to take into account. And he weighed it all out and he was like, okay, I'm good with that. Like, it still makes a lot of sense for me.
Does that like increase or decrease the property value of the property value over time, like as that kind of diminishes or as they get closer to the ending of the Mello-Roos?
It definitely would make it more attractive to the buyer. Like if we're in 2038, for example, and it's like, well, there's really only 2 years left of this, so you're not going to have that cost. Then sure, it's going to make it more desirable. Definitely. Cool. So I've got on my kind of little outline here different property types, which we kind of just covered a decent amount here. So, we kind of went into the difference of single family and versus condo or townhouse. By the way, the difference between a condo and townhouse, for the most part, is that with a townhouse, you're going to have your own private garage. Whereas a condo, you're probably going to be in a more communal, shared, like parking garage kind of thing. I would say that townhouses are probably a little more desirable. Just because of that, because you have your own private garage, which then just means you have more storage. Vanessa, do you want to talk a little bit about small lot subdivision homes?
Yeah, the small lot subdivision home that we just closed escrow on was fantastic. It's brand new development. It was a crazier process because I'm used to really going into like even the inspections part. The builder will be there. He goes through all the details of the property. They fix any little like nick and ding on the property as well as anything that you request. And what's cool about it is that it is your own lot and you have those 6 inches apart from the other properties, which is awesome because you get that's really your property. So there's no like sharing any walls at all, which is great.
Yeah, exactly. If you've driven by them, you probably mistook them for townhomes because they're just these kind of vertical structures that are right on top of each other. But like Vanessa said, there's 6 inches of separation between the walls. Oftentimes they'll put a little panel over it because they don't want like trash just getting stuck in an area that you can never get it out of. So it looks like they're shared walls, but they're not. You're actually buying the whole home. Whereas if you buy a townhouse, you're buying the space between the walls, and then the HOA owns the rest of it. So they're really, really cool, these small lot subdivision homes. Vanessa, what was the address of Coolidge? I want to just pull it up here.
It was, hold on, I'll pull it up right now. Yeah, it was a great property. That was such a smooth sailing. 3034 and a quarter North Coolidge.
I don't think that address is going to be on the MLS.
I know.
Oh, or 3033.
Why don't you do Marathon?
Do you remember that address, Pilar?
Yeah, 3008 Marathon.
Oh yeah, good job. Here, let me screen share. I forget which one we closed on. I think it was this one actually. So this was over in Silver Lake, and it's just like Vanessa was saying, they're going to be new construction for the most part. And then even if you're buying a resale one, the law didn't change for people to be able to subdivide small lots this way until I think it was 2014. So they're going to just be new even if somebody else has lived in it. But a lot of them are brand new construction.
Yeah, like solar panels that you own.
Yeah.
Not leased, which is great. Comes with usually Nest systems and
Everything's tip top, and hopefully you've got a little kind of like rooftop outdoor space. But the main takeaway here is that this price per square foot for new construction in prime Silver Lake, I mean, we're like, the reservoir is like right up here, prime, and we're looking at 604 a square foot. And if this were a house, we'd be looking at probably closer to like 900 or 1,000 a square foot for new construction. The reason why it's lower is because you're not paying for a yard. So, you know, for people, especially a lot of people maybe like in the more first-time homebuyer range, maybe you don't yet have kids. This is kind of the property that you want, you know, to live the next 3 to 5 years out. And then when it comes time to like kids are running around and you need that yard, then you probably want to get your single family, you know, traditional lot and yard setup. But your money just goes towards the nicest home possible with these, rather than also covering like more lot. So are they for everybody? No, but they are really, really cool. And, you know, this one was over $1 million, but the one that Vanessa and I were talking about, that was over right on Frogtown, right at the river, just perfect positioning, right where the art walk is, where all the cool cafes are. What was our, what did we close on that one? 832,000. Yeah. You know, and there's ones that are cheaper than that too. So just really, really a cool property type. Now, another one, and it's kind of good that, that our lenders aren't on anymore, because the next property type I'm going to talk about, they can't offer loans on because it's such a like niche product and there's only 2 lenders that do these. But they're called TICs, or tenants in common properties. And we've closed a few of those lately. Let's show.
They're so cute. I wish we can show Hyperion. Oh, the finishes are so
Hyperion's super
beautiful.
cute. Okay, so yeah, here's an example of a TIC property. So the way these work are, you know, this was a 4-plex. And then a developer bought the 4-plex, the developer vacated the tenants, and then sold the units individually as, you know, and rehabbed the property, and then sold them as tenants in common. And so this one, we actually closed this one at, it was 639,000. So a little higher than that, but still very, very affordable, very good price for the neighborhood. And super cute, super charming, you know, 2-bed, 1-bath, just really cute unit. So the way these work, and the reason why, you know, Bryce and Ryan, they can't lend on them, is because when you buy a tenants in common property, technically you're buying a fractional ownership interest in the whole property with then exclusive use and rights to your unit. And so because it's a fractional purchase, you need to work with a fractional lender. And again, it's a really niche product. There's only 2 of them. But they're really, really cool because they're just going to be a lot more affordable than if they weren't a TIC. Like if they were a traditional property type, you know, this would probably sell for 100,000 more than what it sold for, or maybe even a little over 100,000 more. And so, you know, I'll just show you another one.
What's really cool about this is that also if like you rent in that area, you can buy in that area. So people that rent in Silver Lake, they don't want to move out of Silver Lake to afford a home of this stature. So it's great. TICs are available to some that kind of first kind of getting into home ownership. It's awesome because it's affordable for what the area is.
Exactly. Here's another example of one. I mean, the units are just done so cute. This one had its own little outdoor space. 2-bed, 1-bath, really just well done place. This sold at 663,000. Again, it would have gone for at least 100, 150, 200 more if it weren't a TIC. So just something, you know, and here's the whole community. So in this one, there's six units. And yeah, just something where like, if you guys come across one of these, and you're just like, what, TIC, is that weird? The answer is no. You just need to work with people who understand them. And yeah, they're just going to be like a nice, affordable option, like Vanessa said. For the renter in Silver Lake, you could actually buy one of these in Silver Lake, versus if it were a home, you're probably going, you know, to like Northeast LA or something. Cool. Howard, you want to just talk a little bit about ADUs, accessory dwelling units?
ADUs, yeah. ADUs are, they are, so a couple of years ago, I think around like 2016-ish, California kind of pushed or passed some laws to allow for these ADUs to start getting legalized. What they are essentially are like a permitted back house or a garage conversion, because that was happening so often in LA with such like a dense population issue that we're having, and like they wanted to push for denser living and allowing people that are already doing these like garage conversions, granny flats, or whatever you want to call them, kind of giving them the opportunity to legally build that and then potentially rent it out to tenants. So it's a cool product. It's a great investment for people that own a home. Maybe they have like a detached garage on their lot. Again, this is something that you can legally convert into a rentable unit, and that can turn into rental income for you.
Yep.
Yeah.
And also have your property just go up in value too, having
Yeah,
that.
totally. Would definitely add value to your property.
Absolutely.
Yeah, we love ADUs. I mean,
Yeah.
especially like if your garage, think about this. Like if you want to add another unit and, get that rental income or just have the place for your in-laws or, whatever your need for that other unit is, and you convert your garage, that's so much less expensive than just building a new structure on your lot from scratch, because it's already framed and everything. You already have a roof, it's already framed. You might have to beef up the foundation a little bit to turn it into living space, but other than that, it's kind of plug and play. Just move your walls around. A lot of garages already have like either a sink in it or maybe like washer dryer hookups. So you already have your plumbing.
Yeah.
A lot of them are already wired for electricity, so it's really like not a crazy endeavor to throw your little kitchenette in there, throw your bathroom in there, and then add to your legal permitted square footage, which of course that increases the value of your property. You can legally rent them out. They're just super cool. We love ADUs. And most part, like in general, especially like in the city, it's pretty easy to do them from a zoning standpoint, because there's kind of a little rule where if you're within a half a mile from public transit, which almost everywhere in the city you are, you don't have to like replace the off-street parking if you convert your garage. So yeah, it's just really, really a awesome way to increase the value. Yeah.
So Kyle, talk to me about permit versus non-permit work.
No.
Because we're kind of good at that in a weird way.
Yeah. No, I'm glad you brought that up. I don't normally go into these on these, but yeah, it's definitely like something where if you're looking at a home and there is unpermitted space, like all that means is we need to dig in and learn more about it. It does not mean run for the hills. This is a bad investment.
Mm-hmm.
So what I care about with unpermitted, I don't care if somebody updated their kitchen and they didn't pull permits. That doesn't really mean much of anything to me. What I care about is if there is space that is unpermitted. So like if they added on to the home and it's not permitted, we need to just make sure that you're not paying like top permitted dollar as if they did pull permits. Because does the addition add utility? Yes, like it absolutely adds value, but we just want to make sure that you're not paying for it as if it was fully permitted. What we also want to do a little bit of due diligence on is just try to get a sense of like, okay, are they violating any codes with this? Like, could we retroactively get this permitted? Or is this the kind of thing where just from a code standpoint, it's absolutely in violation, and you run the risk of down the road, you just being forced to spend money to conform it to code. Maybe, and one of the things you see a lot there is if the addition is too close to a neighbor's property. because they're called setback laws, meaning that there's different measurements for the front of the home, the back of the home, and the sides. Generally, the sides are a 4 feet setback, meaning you can't get within 4 feet of the property line. Every once in a while, that addition will cross that. And we actually just closed escrow on a property where our buyer bought it, but we really, really explained to him, like, look, the odds of the city coming at you for this are so low. It's been here for years. So statistically speaking, like, this is not going to be a problem. But you need to understand that if a city official came here, they could tell you that you need to move this back. This is not one where we could just work with the city, have them come out and just retroactively get it permitted. This is one where you're in violation of the setback. And it would cost you around maybe 15 or 20,000 to conform it. And that was the big kind of like thing that he had to swallow and just really process with this one. It was one of the deals where the home was just absolutely amazing, and we just barely won in price. We literally won by like $1,000, and he felt good about it, and was able to move forward with it. But like, we absolutely explained the living daylights out of like what it means, like what could potentially happen down the road. Statistically speaking, it's unlikely, but it could happen. So yeah. Long story short, if there's unpermitted stuff, it's not the end of the world. We just need to really do our homework on what that means and the impact it has on you guys. So
Right.
Yeah. All right.
Wow. Multifamily.
Multifamily. All right. We'll do multifamily really quickly here. Well, first of all, are people interested in learning about like 2 to 4 units, or are people more thinking, yes, Phil's
Yay,
interested.
Phil!
All right, Phil.
We're here for you, Phil.
So we'll do this kind of quickly because, this is one where we could give like an hour presentation on just in and of itself. But we'll definitely kind of run through it. Howard, you want to take this one?
Yeah, sure. I mean, my fiance and I, we're actually looking for our own multifamily property. Multifamilies, like Kyle said, 2 to 4 units, so duplex, triplex, or fourplex. Our plan was to purchase that property, live in one of the units, and then, rent out the others where we have this rental income to help pay down our mortgage. I think it's definitely takes a certain person to want to do that, become a landlord and have that responsibility, because you're not only buying the property, which you're fully responsible for, but now you're fully responsible for all the other the tenants' units as well. The reward is huge, though. I think it's such a beneficial route to go, owning property wise, because you're gonna have the property is gonna appreciate. You're gonna have these tenants paying X amount of dollars on top of your mortgage, or on top of what you're paying. So you're just going to build a lot more of equity, and then it'll set you up later to, our goal is obviously we want to buy a single family home, a house with backyard, but it's kind of something we're willing to sacrifice right now to kind of get to that point later.
Mm-hmm.
Totally. And with 2 to 4 units, the reason why we cap it at 4 is because once you hit 5 units, it's considered commercial, and the lending is entirely different. It's just a little bit different ball game. With 2 to 4 units, you can, for an owner occupier loan, like FHA even you can do, you can get a place for putting only 3.5% down as an investment property. Now you have to live in it if you're going to put that amount down. But normally with investment properties, you have to put at least 25% down. And like, even if you just buy a home, if you're not going to live in it, you're just going to buy it with the intention of renting it. Yeah, your down payment minimum is that 25%. It's much higher than if you're going to own or occupy. And so it is just such a hack, really, to buy a super, like a fourplex, and put not that much money down. You can put 3.5% down on this amazing 4-unit place. And then, you do have to occupy one of the units. You don't have to occupy it for a long time, though. You like, they say kind of like 6 months, you can even just like move in. If you are looking to live somewhere else after that, you can move out after like 6 months time and then get a new tenant in. And this, it's like purely investment because you're not even living there and you got in with paying only 3.5% down. That is just a huge hack basically. And it's awesome. It is super awesome. So there, there's a lot of things that go into 2 to 4 units. We definitely want to make sure that, you're not inheriting tenants that are paying way under market rent and they're protected under rent control, because when that's the case, like you're just kind of stuck with them. So there's a lot of factors that go into it. But like Howard was saying, it's just amazing because like when you buy a condo or a single family home, your investment is just appreciation, which is great. You're getting out of the rental market, but it's not cash flow the way that 2 to 4 units is, where monthly you are getting income from the other units. And when they pre-approve you, by the way, your pre-approval amounts go higher as the units go up because your monthly income is just going to be higher. If you got, $6,000 because the 3 other units are paying you $2,000 a month, that is $6,000 on top of your vocational income. So the price points go up as the units go up with just the pre-approval process. And like, I'm just gonna be honest here, like finding a 2 to 4 unit that you're gonna live in one, it's probably gonna be pretty close to impossible for you to be positively cash flowing while you're living there, because the cost of living in Los Angeles is high. And you should really think about it more as like, they're just going to be really helping to chip away at your mortgage. So like your mortgage, you'll be paying less than you would if, you were doing like a single family thing where it's just you doing it. But one of the big kind of like numbers that we look at when we're working with clients who want this is, okay, will you cash flow once you move out of your unit? Once you're getting that full kind of like full occupancy tenant income coming in, at that point do you cash flow? And that we normally hold as a standard for like, when we're evaluating properties to send to clients. That's normally kind of how we run the numbers is, okay, once you move out, will this cash flow? Because if you're living in it, boy, would that be nice to have purely positive. But in Los Angeles, that's just pretty darn hard. Yeah. Cool. Does anyone have any like 2 to 4 unit questions? Or that's really our last topic. So kind of final round of questions, whether it be 2 to 4 unit or just anything we've discussed so far.
The alternative to FHA 3.5% on a 2 to 4 unit is not living in the unit and buying it with 25% down payment.
Yeah, exactly.
And cash flowing right away.
Yeah.
Well, and that's a big point too. The more money that you put down, the lower your mortgage is just naturally. So I don't want to say like if you own or occupy it, you could still cash flow, but like you'd be putting definitely more than like the bare minimum skin in the game amount. So yeah, that's definitely a good point, Pilar. Anything else before we wrap up here, guys? All right. Well, thank you guys for joining us. I hope you guys found this useful. And, we would just really, really love, like, even if you're 2 years down the road, like, please reach out to us and just, let's set up a time for just a private Zoom where we can just kind of hear what your goals are, what your plans are, and can help kind of just put a roadmap to get there. Because this is a big deal, and it's not the kind of thing where you just wake up one morning and you say, today, you know what, I'm going to buy a house. Like it is something, it's something that you really plan for. You really want to have a roadmap to success. And between us on the real estate side and then Ryan and Bryce on the finance side, like we would love to just have these kind of like initial intro conversations with you guys to just help kind of put you guys on the path. Again, even if you guys are a ways out. So With that said, thank you guys for joining.
Thank you guys.